Hi everyone, thank you so much for coming here today. I'm Janvi,
And I'm Anuj.
and we're the co-hosts of Breaking Uneven.
Yeah, so today we've got a really interesting event for you, and I mean, the context is already up on the screen. You'll have seen what you'll are coming for. But something that we're going to try doing is going into an actual deep dive so that you'll get valuable, actionable insights.
And yeah, without any further ado, we would like to ask Jaynit Raheja to come on stage and get this started.
Hi everyone, thank you so much for joining us this evening. My name is Jaynit Raheja. I run a boutique real estate firm called Qube, and I'll be moderating the session with you all today. So without wasting any more time, I'd like to call our speakers and invite them on stage, starting with Binitha Dalal, the co-founder of MK Mount Capital. Next we have Antriksh, the head of luxury sales at Birla Estates. And finally, we have Dhimaan Shah, the co-founder and co-CEO of Isprava. So we're going to try to keep this conversation as casual as possible. At the end, we'll have a short Q&A as well. And when we were sitting to think about what we want to get out of this session, looking at the speakers that we have, the thought was to do a slight deep dive into seeing real estate as an asset class, in terms of investments, in terms of just purely looking at it as an asset class. And we felt like this is the right audience, right set of speakers to quiz about this topic. So before we start, can we just take a minute and I'll ask you guys to just give a quick introduction about yourself and what you guys do, and then we'll take it from there.
So what Isprava does, and focus on Isprava, not anything else. We're a group of luxury brands. Two of them are in the real estate space, one is in hospitality. So we have, as part of the group, we have one brand called Isprava, where we build what I like to think of some of the most beautiful homes in the world, not just in India. We operate in non-urban locations, so Goa, Alibag, Kasauli, launching Karjat soon. And then, of course, we have a hospitality brand called Lohono. What Lohono does is it manages and services all our assets nationally. We are now by far the largest luxury private villa rental platform in the country. Our third brand is the Chapter. It's also a real estate brand, where Isprava averages about $1.5 million as a sale price. Chapter is your $500,000 home. So we have a Patek Philippe and we have a Rolex, and that's how we think of the real estate brands. So that's just a quick, short introduction.
Great, thank you so much. Binitha, you want to go next?
Yeah, so Mount Capital is India's first privately promoted development fund business. It was started by me as part of the Rustomjee group, and it's something that we've created where someone can own 10 homes at the cost of one. And I'll elaborate more when we talk about more. But yeah, so largely it's a fund management business which is investing in real estate as an asset class.
Perfect. Thank you.
So I'm Antriksh. I'm a part of the Birla group. I would not say too much about it. In fact, the place where we are currently, it's also owned by us. We're into multiple businesses. Real estate was the last one to start. Actually, not the last one. We have done two more interesting ventures, which includes jewelry and also where we are. So that's called Birla New Age, where we understand the next generation's need and other things. In real estate, we've been doing everything now. So started as a luxury player. So for us, luxury was very basic. You should enhance your lifestyle. It was not dependent on the sizes which we were doing. Here in the current company or at Birla Estates, I'm looking at the large value portfolio for them, where right from designing a product or maybe when we are acquiring a land parcel to the sales strategy, which is most important in real estate. So that's what we are doing. As a company, we have presence in now Mumbai MMR, which has been very, very important. We started with experimenting in some of the outskirts. We are now acquiring land parcel in Pune. We are doing 2 projects, 3 projects there. NCR, we are expanding ourselves, so we are launching a big one there as well, and we are doing a couple of things also interesting in Bangalore, where we're just launching and it's just getting sold. So we are running shorter projects. So Bangalore has been very, very interesting lately, and Mumbai has always been where our group started everything from. So it's very important. So that's where large focus is being on real estate. So that's pretty much about us. We're around 30,000 crores listed player. A lot of people don't know it. It's called Aditya Birla Real Estate because it was earlier called Century Textile. And my focus here is large value. That's what they've hired me for, and that's what I've been doing with them for 5 years.
Perfect. Thank you so much. I think this was a great round of quick introductions by everyone. So when we looked at, now coming to the next question, right? When we looked at what we want to start with in this conversation, what we realized is everyone looks at, like today, everyone has X amount of money that they look to deploy. There are multiple options, whether it comes within real estate or outside real estate. And what we wanted to do was give the audience a chance to kind of evaluate the different options available to them while investing in real estate. So say today I am sitting here in front of you, I have 20 crores to deploy into the market. And I come to you to ask, like, what do you see myself doing with that money in regards to your company? Can we go around the room quickly and get a quick answer where we can then dive deeper to analyze that investment opportunity?
So, first I would ask you a lot of questions on this point, like where is this money coming in from? Is it an asset sale? Is it coming from some stocks which you're selling? Because a lot of taxation implication also comes in. Then where you are currently in your stage, are you already having a current house? Do you wish to enhance your lifestyle? Or is it only real estate? There are fund houses also which gives you a lot of return. So it depends on where you are, and then only as a real estate person, I would be able to give you a right solution. So 20 crore today, if it is coming from an asset sale, obviously there will be a lot of capital upside on that. So you should buy something which is just ready. You should get some rental income also on that, so that at least your capital gains are also taken care of. Maybe buy something under construction so that slowly you can build up on that.
So if we break it down into 2 types of buyers, someone who's buying it to actually use the apartment and invest it, right? Because a lot of sales that you all see in luxury are people who are buying to use as well. So when I am, as an investor, sitting with liquidity of 20 CR that has either been generated from an asset sale, either I have performed well in my stock market, I have to buy something for my kids, or I'm planning the future of my family, what would the core of...
See, if it is coming from stocks largely, that means you are trying to enhance your lifestyle. It's not an end use, you already have a house, right? So then maybe diversifying, buying a couple of assets, looking at some rental ROIs will make a lot of sense. At the same time, if you look at your current home and you feel that, I need this money after 20 years, it should grow, I can leave it like a legacy, maybe buy something under construction so that you can get that value also.
So just building on 2 questions to that. In terms of ROI, what is the typical ROI an investor coming in today for residential can expect from the market?
See, there are 2 ways to look at ROI. So first way is the rental ROI, which we all talk about, which is, at least in larger cities, the best part is that you will get consistency of that rental. Second thing, which is very important in real estate, is the exit timings, right? A lot of times we invest in assets and we don't get the exits at the right time. So if you are in the city center, you will require that return to come in, that exit to be there in 15, maybe let's say 15 days to 6 months, 8 months, then definitely that should be deployed in a large value real estate, because your per square feet rate is also a little higher. Because when we say luxury, it's not about the space only. It's also about the kind of things which a developer is kind of putting on the table. You will get some lifestyle enhancement, you might get some clubhouses, you might get some design which is better, or maybe a lot of other things which come with it, which attracts a lot of people to buy it also largely. So that's where I feel that maybe if that 20 crore is deployed in a way where you're buying something under construction over the period of time in Bombay for 10 years, you would get a very good return, which we've seen in the city.
So just for the audience out there, like if say I go into a project and I'm buying 3 like under construction today, what would be the ballpark kind of returns that you see in the market moving forward? Like say from now, say 5 years from now, not to where we are, like just moving forward.
So see, there are a couple of factors. So most of you are from Bombay, right? So maybe we can take in Bombay example, right? So land is becoming expensive. In fact, we are not manufacturing land. That's what everybody says. We are going for redevelopment. We are going for different instrument where we are making slums, good homes, and we are trying to create better properties there. So one thing is clear that the land prices are shooting up, which was earlier 80% of the total cost of whatever you were paying 80% for the land parcel, right? Now, developers, wherever you see that his construction cost is not just 20% or his project cost is not just 20%, it is about 20%, maybe 30% he's investing on the product also. That's where you will see a lot of people attracted towards that property. So you should be very careful on, kind of wherever you're selecting, and that's where your ROIs will be higher. So next 5 years, definitely there will be a very large chunk of upsides which you will see. And currently also, if you see difference between an under construction property which is selling at 1 lakh and the ready property in that same micro market achieving maybe 130, 145, if you look at that basic 6-7% which Bombay always sees, we should be at a comfortable state. So and plus you're not putting the money together, right? You can really put the remaining money somewhere and make some returns on that. If you calculate all of that, then you're looking at doubling your money.
So that's just a very valid point, which if you could just elaborate a bit, like when you're buying a property, you're not putting the entire amount upfront typically. So say I were to go today and purchase a 20 CR apartment at a project that is getting delivered in 3 years. What is the kind of capital I have to lock in today? Or, like what are my options? Because then in that case, it goes into more of an asset planning category.
See, again, asset planning becomes very important. And again, cash flow planning rather becomes very important. So today's generation, because we meet a lot of people, I don't get to meet a lot of buyers, but post the sales happen, sometimes you're interacting with the family, you want to understand why you have bought. So the next generations are very smart. They're very smart with their money also. So here, the idea is that in 3 years, if something is getting delivered, before the structure gets ready, RERA doesn't allow you to take more than 70% payment, right? If the asset is of 20 crore rupees, if you do 70%, it is also coming in parts. So currently you're putting in 20%. Then every year, let's break it down into 3 years. So maybe 33% every year is what ideally you are paying. And on that 33%, a differentiation between a ready and an under construction property, you have to be very careful of what you're selecting. You can't just select anything and then just think that it's not right. But essentially, 30% is what you pay in the initial first year if it's 3 years away. And the next year again, you pay about 30%, and close to delivery, you're paying about 30%. So if you look at past experiences, maybe we all have witnessed that there have been properties which have started at maybe 40,000 rupees in this micro market. They're going for 1 lakh 10, 1 lakh 15, 1 lakh 20. The rentals are shooting up to a level which was never imagined, which nobody imagined. But certainly the city, at least in Bombay, it requires a lot of upgradation because unfortunately for us, fortunately for developers, unfortunately for all of us who have grown up in the city, the livability quotient was very low. So there is a lot of demand where people are upgrading, and that's where you will see for right properties, the prices are going up, but people are really paying an arm and a leg for the right kind of property. Where at the same time in the same micro market, it's not defined by micro market anymore. So there you have to be very careful. So maybe 30% now, and remaining over the period of time is what you're investing.
And lastly, before we move on, do you think that as investors today or as people purchasing these properties, the client is more protected with RERA? Has there been any positive impact from that?
So it's a turnaround completely. So it's been about 15, 16 years for me in real estate. Started with finance where we used to create models which was protecting the investors largely first because they would not trust us as a developer. Then the clients would not trust us. They would always wait for a ready property to be there, and he was willing to pay a premium. And that premium also we couldn't define at that point in time. With RERA coming in, everything is documented. You go to a website, we all have our phones, you go there, buyers are pretty well informed. They check everything before they come there. They know the status, they know the legality, they know the land title. There is no hidden things. And largely developers are also making it very, very transparent now. So the moment you walk into anybody's office, you would be surprised to see that earlier it would be one floor plan, which we all have seen. Here now they will sit with so much of detailing, so much of virtual understanding. AI is also helping in, a lot of technology driven things are also helping people to decide. It's not just about a sample house. There are too many things which after RERA, developer is able to. And which is also protecting your money largely, and which is changing the game largely as well. So whether you buy under construction or you buy ready, you are all protected by the government completely. it's like SEBI sitting on our head. At least in Mumbai, yes.
So now moving on to Binitha. Similar question again. We are looking to invest.
You made it 20, not 50.
We can keep it at 50 also, it's fine.
Even I thought it would be 50, it would be easier.
50 easier for you, no? And you, Valkeshwar. No, okay. No, but, it's a very valid question, and I think I probably have seen real estate since the day I was born. So for me, I understand what he just said, and to just also bring it out in a perspective, because the bigger, I would say, conversation that always has happened is what does RE give? What does equities give and what does RE give? Because when you talk about investment, entire world is boss, stock market. They see 3 years, it's doubled. It went from 28 to 75, 80. This is the place to be. And now when you go back to them, they're like, boss, 80 has become 75. I'm down by 15%. It's about timing. It's about product. And real estate as an asset class for India is probably the most important product. As much as we may all talk about equity, SIPs and everything, everyone's portfolio, the most chunkiest investment is always RE. Has it given a return? Most definitely yes. I don't think anyone would continuously buy homes otherwise in that situation. It's not just about owning homes, but it's also passing it down from generation and generation. It is that one emotion that keeps you going. Flats generally give you a return on an average across about 5 years between about 6-7%. Yes, you get a hedge on cash flows. It works, but it's also locational. The one thing that has given maximum return to people is land. Land is something where people have just not seen money's double, but after, say 5-7 years, some people have made even like 100x. Classic example is if you look at the Oberoi development in Goregaon, it was for him generational land, and today it's like his biggest valuation. So it works. So land is the one place where you would invest. If you give me 20 crores, I'll put it in my fund. So I'll tell you why we built this fund. I've been part of real estate since the day I imagined. It was my playground. Like people went to parks, I went to a construction site. That's how I've kind of seen real estate come up. And for the longest, I used to wonder why people don't want to invest in a real estate AIF. Across my journey, I probably would have always been on the development side as a developer, working with people, going to investors, going to PE guys, going to people and asking them, invest with us. You definitely are making more money because this is a hard asset. Put money in a startup, it's all a loss-making company. Someday he will give you the profit here. The money is coming up and it's going up. But people never put that trust in RE as a sector. Thankfully, I think it's changed over the years. Government has changed it and all. But when I went to investors to put money in an AIF, because our AIF is probably the first developer-promoted AIF in the country. After us, a lot of people then came in and did that and all. And our first fund is $100 million. We are fully raised. In fact, we got I think I'm going to go with Dhimaan. I'm going to touch wood, not to jinx it. Actually, we got oversubscribed. When we started this journey at 100 million, we never thought that we'll kind of get there. But our fund actually got oversubscribed. And a lot of it changed when they realized what we are building. When you enter at land stage or invest money at land, you're coming at cost. When you buy an apartment, it's cost plus profit. When you buy a completed asset, it is only profit after OC. When you get into land, that's where you kind of get a platform, and that's where you get to ensure that your return is probably on an average of 25% IRR in 4.5-5 years, provided everything works well and the market survives. That's how we built this product. Our platform is a platform where you get to get in at land stage. You get 10 assets. Rustomjee is our development partner. Our fund today is at an average of about 35% IRR across the first 5 investments, and we're hopeful we'll kind of exit it at least 2.5-3 times in about 5 years. But that's where I would put money with. So if you ask me, you give me 20 crores, I'll either buy land or directly invest with a developer at land stage or get in at a project at inception.
So just to clarify, is this pre-acquisition of land or post-acquisition?
Pre-acquisition. At acquisition. You get in at a point and you only put money with the right people. The first person or first rule of investment is relationship and people. You put money with the right person, enter at the stage where the land is identified. That's where you make probably 50% of what you makes. and he does all the hard work. Real estate is the most thankless job on this earth. I keep telling all my developer friends that we must be crazy because every morning someone comes and cracks on your table and you are like, yes, please go ahead, whether it is your contractor, your customer, or it is RERA, or it is your regulator, some way new rule changes, someone flies over some place, some flamingo wants to fly, they shut down the development in the city. It is the most thankless thing. And after you deliver your building, even after 10 years, if a tap is leaking, it's a developer's problem, not anyone else's. So it is genuinely, I'm telling you, I don't know if you guys got to know, but NGT one fine day passed an order and demolished all the buildings in Kerala on the bank front because they thought it was in an eco-sensitive zone. After government gave that was crores and crores of rupees, hundreds of crores of rupees down the drain. And who was responsible for all that? The developer. So it's that. So yeah, at land.
So if we look at the process from land acquisition to the customer buying it right at the end, based on that thesis, would you say that maximum value is being added to that journey at the start on the land bit?
So I'll break it down, like how if I'm buying hypothetically, I'm not going to give this land's example. It's too expensive for 20 crores, but hypothetically, if you're buying a bungalow in Bandra, okay, assume it's the 1960s and they were sold at some couple of lakhs, but today we say 20 crores, okay? Suppose you bought say 1,000 or 1,200 square meter bungalow in Bandra, 20 crores, which includes your approval cost so you can start work. On day one, when you start or you put your money with the person, okay, you enter into a contract and you come in and you have visibility of what approvals and what you can build over there. You're not putting money and waiting for the approvals today. Thankfully, today regulation in real estate has advanced where the minute you put your money down, you know how far you are from approvals because it's no more that multiple people come and give multiple ideas. You know there's one person, he will give the approval and it comes faster, especially for small projects. So it's at a stage where probably you put money and approvals are probably 6 months away.
So typically for y'all at Mount K Capital, y'all are looking at land parcels within city limits?
Well, first fund, MMR, round 2, we partner with third-party developers, not just Rustomjee, across multiple cities. The reason why we wanted to build a development fund is because the biggest risk that you run as a fund manager is depending on a developer to ensure your project is complete. Most funds come with financial acumen. This comes with development acumen. Round 1, we wanted to do a test market where we go to the market and we prove that this concept works. And touch wood, God is kind, it has worked well. Round 2, we will always work on this and also lend to third-party developers where we always come with development expertise, which means tomorrow if things go wrong, we as Rustomjee will take over the asset. So it comes with that confidence which ensures that your investor's capital is always protected. And how that works is if you look at land today in Mumbai, land cost today is almost about say 25-30% including approvals. Construction is another 20%, interest, admin, and the rest takes up the rest of it in terms of your construction cost and your land cost. Your first 20 or 30% defines the profitability of your asset. If you come in at a stage and if you do redevelopment largely, your monies are staggered. So you have to put 10% of the overall revenue as your seed capital. At 10% gearing, you make 50% of the profit. It's a better return than equities today.
So coming to that point, right? Like now in India, everyone is very hardwired to look at, I put X amount of money in real estate. Now my real estate value has doubled. I'm selling it. Now I have capital gains coming in. I have this taxation, put it back into real estate and keep rotating it, right? Now, how do you convince that person who's so hardwired to that reinvestment to save tax, where you're now telling him, okay, come to an AIF structure where maybe your capital gain benefit is not pushed onto you, so you're allocating different capital now.
I thank our finance minister who capped capital gains at 10 crores and brought in something called GST and stamp duty, because every time you buy an apartment, you spend 6% of stamp duty, 5% GST, 11% of your capital value, and you don't get more than 10 crores in capital gains. That also for twice. So I thank her. But jokes apart, I think someone who's always hardwired in buying apartments, today secondary sales are not as easy as they used to be. And if someone, in fact, one of my investors is someone who has like a very large portfolio of apartments that he kept investing and buying, and now he's like, for me, managing those apartments is an issue. My son doesn't want to take care of it. I want to liquidate all this and put money in it because this platform solves it. Any AIF, okay, it's not us. I'm saying any AIF where they are looking at doing hard investments, you can see what your end use is and you know who they're investing with, is a platform which is seamless for you because you have someone else who's managing and praying every day to God that your money is coming back. You can come in the next round, but he will do it in the first round and take care of it. But I'm saying it manages the situation for you. So it's an easy fix. But someone who's only interested in owning apartments and loves that feel, you can't change them. You can only tell them that don't put your entire amount, put part of it and then come in the next round. You'll at least experience what we're doing because we're always going to be here.
So, if an investor comes to Mount K Capital when you're in your first raise, what were the minimums that people were allowed to put in?
So I think we've been very fortunate. I keep saying this, I keep thanking God every day of my life. When I joined real estate, I always wanted to get into financial business because I realized during the GFC that this is it. Money is what fuels the growth and money is where you make money. And for me, I come from a concept and it's drilled in my DNA that boss, money needs to make money. If you don't make money, then you're doing CSR, then you're not doing business. So that's where I wanted to kind of switch on to it. And when we formed this fund, there are only three things that we wanted to clean out. A, we wanted to create a brand which would deliver probably the best return that real estate as a sector has seen for AIF investors. Two, we want to create absolute alignment of interests. So our fund thesis is so extremely clear that only once the fund makes money, then the developer makes money. Priority is there, but at the same point is absolute alignment. Everything is from there. When we went for our first round, it was not an easy market. No one had heard of a concept like this. No one had heard of a development fund backed by a developer. Anyways, everyone thinks that developer chor hote hai, some of them are related to some Dawood or somebody else. In spite of that, when we went out to the market and, we got supported by some very good names. State Bank of India came in with 10% of the fund size from the treasury. Family Care, India's largest family office, put about 15%. God was so kind that 60% of our fund is institutional. And we also have very large chunk of HNIs and people who came in because they saw that this is a product where they know that their money is going right here and they know that there's a deemed exit. Traditionally, when funds went to people and lots of family office, they said, boss, this is my investment thesis, this is the brand that backed me, you give me my money, I'll go find a developer, then I'll find the product, then I will go deliver to you, and then, we will all make money and so on and so forth. And they were largely a debt product. Most funds have been a 10 to 15% debt product. Ours is a pure equity product. We didn't go to the market, the blind pool. We said we have a very clear identified pool of assets. 3 assets were already seeded by us in the fund and, work had started on it and this thing. And we said that all new assets will be acquired jointly and your money will go very clear. We were able to convince them to see value and also convince them where they saw that they can see that the return is crystallized. My first 2 assets from the fund which are invested and running, first asset is about 90% sold out. I'm going to start returning monies in less than a year. Second asset should be sold out to the extent of 80-90% by end of this calendar year, and that money should go back as well. So the thesis worked, the concept worked, and that's where we saw a lot of HNIs come in as well. But we got chunky numbers. In the entire 790 crores that we have, our total number of investors are not more than 80.
So the reason I ask that is, do you see this being a product that, like typically right now the appetite within real estate, whether we've seen the listed players come in, whether REITs are coming in, developers are listing, SM REITs, like all of these guys, we're seeing a lot of the appetite comes from institutes. Do you see that in the future coming down to the retail investor, or what would be that path for the retail investor to look at?
We are creating a different product for retail because I think, it comes from the passion for this sector. We've always wanted to do something better for the sector. We're part of an association called CREDI, which is a Pan-India Association of Developers. Baban Uncle as a president, I had the youth wing this year, and always we've gone extended to create something better for the industry. We definitely are going to come on where we want to work with the retail investors so that they can come in. Regulation has been extremely supportive with SM REITs coming in and REITs coming in. I think REITs are a game changer for this country. And more, I can see it from the regulators because I've had the good fortune to interact with them at multiple occasions. They are extremely clear. Protection of the investor and ensuring investor has absolute transparency and clarity is their most important goal for any regulation. And the way they came out with the SM REIT also really fast is going to change the way it works. In fact, I won't be shocked that you will see an SM REIT for residential as an asset.
Yeah. And that's definitely true because when we look at mature markets like the US, right, like they list everything as REITs. So you have a prison REIT, for example, which is literally prison cells that are just listed. So
that's an asset class.
That is. So we are going to see that kind of maturity come in for sure.
I'm waiting for my Uber driver to say कि मैंने इतने REITs में डाले हैं, because I remember the first time I went to Singapore, and it was the only thing that I remember in my cab drive over there is that guy had investments in 4 REITs and all his savings were in REITs, and he's like, it's the best thing for us, it's the maximum return and very this thing. So I'm waiting for my Uber driver here to tell me that, boss, I have put money in this SM REIT or this REIT. That's where India has arrived.
No, I'm sure it's just a few years down the line and we'll get there soon enough. Just last question before we move on, in terms of structuring, how do you compare with the AIF structure compared to, say, me as a retail investor, when I have an option of either putting directly into one apartment is one option, obviously. Second option is to go and buy something listed. So I'll pick up a REIT asset or a developer and I'm betting on that developer. Third option is, maybe get into invest into a fund where the fund is on my behalf, investing further out. Fractional unlisted also is an option. So would you put them in a similar bracket?
I will put them in a bracket. Okay, so let me try and do it. REITs are akin to FDs, risk-free. Okay, apartment is opportunistic / something that you want to create a rental income from. Otherwise, just holding an apartment today doesn't make sense because you are losing 11%, especially when you get an under construction. So that I wouldn't say that. I wouldn't recommend that to people. Unless you want to build a rental portfolio and you want to give it to someone, or you have something that someone in your family in future will use it, definitely yes. Fractional ownership, great. Moving to the REIT structure, so even more better for them. And I won't be sure. I'm waiting for a residential fractional ownership. Probably you guys should do it. It works best for you all, genuinely. Yeah, but not as at the scale at which do it. Most of there's only three SM REITs that have come. One happened for Prestige, and 2 more are coming in. One is Strata, and one more. So only 3 people that.
And all of them were subscribed by institutes.
Oh yeah, they're actually also from investors.
I was sitting with the Strata team, that's what I was asking them, and they were like, no, we got a full subscription.
Sudarshan is all that. I'm all institutional, but he's the biggest retail investor in guys. So yeah, but no, they have retail, and the only challenge with is that the entry barrier, the minute it becomes structured into a regulator, it becomes like you need to have a minimum check size, which was not the case in that unstructured way. But yeah, and it also depends on return. So again, a fractional return would be slightly higher than an FD, and it depends on when they exist to give you a higher return. AIFs, debt AIFs are a 15 to 18% game. Equity AIFs are a 25% game.
In terms of liquidity, any difference for me as an investor in terms of options to liquidate if I need to?
AIFs and fractional, and so SM REITs are the only places where you can liquidate easier. And apartments, you have to put it on sale and you can get it at your own space. AIF units can also be traded. But the thing is, in an AIF, your entry barrier is 1%. That's the only thing, unless you become unless you are under the recognized investor bracket, then you come in with a 25 lakh check. So that's the only.
Again, I'm going to use this as a good segue to get to Dhimaan, who's been patiently waiting all this while.
He has all the knowledge. He'll sum it up and he'll give you the most aced answer of all.
I'm sitting here learning at everyone's feet.
So Dhimaan, same question to start with you. We're sitting with 20 CR looking to invest, and we come into Isprava's office Where do we go from there?
So, firstly, very, very loaded question. I meant to tell you before anyone answered. No, because look, my world is very, very different. Actually, I was genuinely hearing them speak, and my world is very different. 6%, 7% capital appreciation means karo hi mat, hamare dhanda mein. I'll give you data points, right? In the markets we operate in, which are primarily, like I said, non-urban. If you zoom out and you actually think about real estate, there are fundamentally only two drivers of value: land and brand. The land that you're buying and the brand that you're building on top of it, and that's it, right? And within land there is the quality of the land, the views, the location, blah blah blah, micro location, all of that, and then brand is, again, and we have a very different take on luxury, which if we get time, we'll get into later as well. But essentially, the brand that's building it, right? Whether it's a mass market project or it's a luxury project, there are great brands across the country doing great jobs. So, when I talk about land, right? Let's talk about land for a second. If you look at the micro markets in Goa that we operate in, right? Like every real estate market, there are micro markets. If you're not seeing an annual, I'm buying land every day, right? 100% growth, minimum. Last year you asked 10,000, today you're asking 20,000. If I'm getting at 20,000, I'm lucky, I'll buy it immediately, as subject to diligence, etc. We do a lot of secondary sales, means of our home. So you bought a home with us, you now want a larger home with us. So you'll say, hey, can you help me exit this property? If we're not giving, we just exited someone in Alibag on Monday, who delivered the home in late 2023, 100% exit. They paid 100, we got them 205 on Monday, right? So if we're not delivering those returns, for us, it's no fun only. We look beyond. So if you're coming into my office with 20 crores, A, you're going to be a very rich man. B, you're going to be a very happy man, and I'll get to why. For us, right, again, we're not building in the cities. So it's not about someone coming in talking about their third apartment in Bombay, right? They're coming in because they want to truly elevate their level of living, right? They want their children to breathe better air. They want their families to be in nature. They want to have a little, getaway, which, if our clients from Delhi spend 4 months of the year in Goa. Our clients from Bombay are in Alibag 3 days, 4 days a week. Many of them commute to work. And now with all the infrastructure happening across our country and across Bombay, Alibag by road is going to be an hour away, right? From Birla, it will be maybe less than an hour away with everything coming. So that's one part. The second part is we also run effectively an in-house unstructured AI, right? We deploy and raise about $85 million a year and deploy it and give equity style returns to our investors. These are your largest family offices, these are some institutions, etc. So, depends on your risk appetite, depends on what your end goal is, depends on your flexibility. Many times, a lot of our investors are also our end buyers, and it really depends on all of that. We're essentially a one-stop shop. If you want to invest and get land exposure, more than welcome. If you want to buy a 20 crore estate in Alibag, more than welcome. You want to have a home in Goa and Alibag of 10 crores each, more than welcome. We have a solution for you. The good news is you're going to make a lot of money whatever you do with us, right? And that's the way, very, very simply, I would approach it. If you walked into my office, we'd essentially just try to understand what your goal is, right? And then tailor something.
No, definitely. And that makes it a very tempting offer for any investor looking at it. But at the core, is the investor who is looking to invest in an Isprava home, looking for a second home predominantly? And if yes, is that second home something they want to monetize? Is that something they suddenly decide once it's ready, I might monetize? Or is it something that's not on their mind?
So statistically, again, and we'll just start with some numbers, right? About 35% of my homeowners are what we define as semi-primary homeowners. you're spending 8 to 12 months a year in that home. That's about 35%. And the remaining 65% is divided, fairly equally, where one chunk is spending about 4 to 6 months in the home, and that will be in batches, right? Not straight. And then the remaining, which is less than 4 months, right? So the way they use their homes are very different. The guy who's using it 8 to 12 months in a year obviously is not looking to monetize the asset. The guy who's using it less than 4 months in a year is definitely looking at rental yield. The other beautiful thing about our business is in Bombay, if you're lucky, right, you'll get 1% if you're lucky. And I mean that you have to be really lucky. But in our markets, and that's gross, right? In our market, gross 8-9%, and net would be about 5%. If you're unlucky, 4.5%, but in and around 5%, right? So you monetize it through rental yields. The people who are using it 8-12 months in a year obviously don't, and the guys who are using it in between are okay walking away with a lower rental yield because they're obviously available for that much less. And that's where Lohono becomes so important, right? You're managing the asset, you're renting the asset, you're sweating the asset, you're maintaining the asset, you're maintaining the staff in for the asset. So it's really important to have that ecosystem in our world, because it's not like buying in Bombay where it's much easier to do all of this, right? There's so much more access. There's only so many people you can access in Aldona at 2 in the morning, right? or wherever in Dhokawadi at 2 in the morning, right? So you need that ecosystem.
So just to again go a bit deeper into Lohono as a thing. So say I'm an apartment owner with Isprava, and I opt in for the Lohono service. So I could choose what days I am subletting it for on Lohono and make it available, or do you all take it like 6 months, you give us the apartment and?
Yeah. So again, I'll kind of go in greater detail than you perhaps want to hear, but we are very, very technology focused, especially on the Lohono side, right? So we have an in-house product team of 18 people, right? That's just a pure play technology team. So everything is built on one ecosystem. As a homeowner, you have an app. Your app has a live calendar. You as a homeowner throw a party at your house and you're having a good time till 3 in the morning, and you break a leg of a chair. Just take a photo, move the chair to the side, upload it on the app, enjoy the rest of your holiday. By the time you're back the next time, this chair will be fixed, a photo will be uploaded. We pay your property tax on your behalf. We have a 24-hour concierge for you. If you're coming to Goa, your EA or secretary will just inform the concierge team, who will have and will know that you like a BMW to pick you up versus she likes an Innova versus he likes a Swift. We know what fruit you like. We know what time you drink your espresso in the morning. So you're not going to wake up at 6 in the morning and tell your staff, hey, can I have an espresso? At 5:59, your espresso will be ready for you. Now, you might not wake up at 6 that day, and then that's a different thing. But so it's all built in this technology and in this backend. Everything kind of comes out of there. So you can block your dates in advance. You can block the house for the whole year if you want. You can put it on rent for the whole year if you want. It's totally up to you, and it's all done through the app.
And the pricing algorithm, like you guys would recommend a rate to lease it out at?
No, so we won't recommend a rate. We will decide the rate. We will fix the rate, and we won't have too much of a conversation with the asset owner on that, because that's our expertise. It's obviously driven through real-time demand and supply, and it's a fairly complex back-end working to make sure that where this magic mean between occupancy and rates is always met. So Goa between December 15th and January 15th is exponentially expensive, but Goa now doesn't really have an off season. But of course there are months which are lighter where your prices will come down a little bit, but your occupancy will be higher. So we just keep doing that dance.
And you mentioned this earlier, but just to go back to it, right? Like when you mentioned Isprava, you said the ticket size is quite high to start with. What would a rough indication of the ticket size be? And then basis that, see, it's not the primary asset the buyer is typically owning. So then basis that, what do you see the typical net worth individual? Like, what kind of category of people is your primary audience?
So Isprava's average selling price is, like I said, about 1.5 million US.
Which will come to around 12 crores.
Yeah, between, call it 12 to 14 crores, right? Your average selling price. On the highest end, we have a 100 crore home, but we have nothing less than $1 million, so say 8 crores, right? The way the dollar is moving, but about 8 crores, right? So, you'll be surprised actually. What we find is the billionaires are spending 10, 12, 14 crores. The guys who are not billionaires are buying the 100 crore. So, I think what I've learned and what we've learned is everybody is a client. Point one. Point two, it's very difficult to know anyone's net worth in this country. We've not figured it out. We're not smart enough to figure it out. So I think everyone is a client. We have people who, I don't know, I assume or I think are worth 60, 80, 100 crores buying 40 crore homes. And then you have people who are worth, 20,000 crores buying 10 crore homes. So, honestly, the way we see it is the world is our playground, right? We also have a big international buyer, right? About 30% of our order book comes from Singapore, Hong Kong, the UK, US, again, NRIs primarily. So, we believe we have clients everywhere.
And the NRIs are pretty much are buying it because they come visit India, live here, or just for a rental perspective?
Yeah, no, it's actually, look, NRIs are coming to India often, right? Your cities are becoming more unlivable by the day, right? In Delhi, there's pollution. In Bangalore, there's traffic. In Bombay, there's pollution and traffic, and so on and so forth, right? So NRIs now are saying, hey, when I come back to India, I don't need to be in Bombay anymore, and I don't need to be in Delhi and whatever. I'll visit India and I'll go to Goa, and if my parents who live in Bombay, they can come to Goa and spend that week or 2 weeks or whatever with me, and when I'm not here, they can use the home. So it's actually for usage. That's the primary reason, and then they're saying, you know what, it's great. I get a rental yield also. So I'm not putting my hand into my pocket for the asset.
And you also mentioned about chapter, where the ticket sizes come a bit lower. So just the basic thought behind that and what the market has reacted to with a product like chapter. Yeah. So, when I think strategically when we thought about the chapter, we said, look, Isprava is, like I said, 12, 14 crores on average to buy a home, right? But there are a lot of people who want access to what we're doing. And how do we kind of give it to them, right? Without compromising on what we do, which is the quality we build, which is the design, and we're very design-led and design-focused, etc. So the way you can do that is 2 ways. One is, of course, reduce the size of the parcel of land you're giving them, but offset that with a whole load of amenities, right? In common areas, clubhouses, pickleball courts, and gyms, and cafes, and all of that, right? Which is what the chapter is. Smaller plot sizes, slightly smaller home, but still spec'd up to the quality and the this thing that we stand for. So the average selling price for chapter home in Goa is about 4.5, 5 crores. The average selling price in Alibag would be 4 crores, and Karjatwe might be a little bit lower than that as well. And it just opens up a whole different market, right? Your TAM just explodes, especially in a place like India. We've launched and sold 2 projects. About 12 days to sell the first project, which is 22 homes, and about 1.5 months to sell the second project, which is 31 homes. So the market is just so big for that ticket size, and that was predominantly the thought process, but still provide the quality and the service as well. I think that's very interesting from the service lens is I think especially very interesting, because for that clientele that we are targeting, for them to have that service, to get that car pickup, to get that coffee in their hand is quite important. And I feel it pulls back to real estate in general for an investor versus like when we look at equities versus real estate, like it's a lot more tangible. So just having that service, having that physical house makes that difference for sure. I think I am done with this set, but anything else that you guys would like to add, because we didn't go back and forth?
Largely, a lot of NRIs are also picking up things with you because you are able to give them that hassle-free ownership, right?
Yeah, absolutely.
That's also very, very important, because I know of people who have picked up properties with you and they're gaga about the entire subject. And I'm also a very big fan of the model, because I've been following you guys from very beginning.
Thank you.
But largely what I have seen, overall in real estate, a lot of large value homes, when we call it, In fact, especially with the kind of things which we did here, so we did around 100 odd apartments in like maybe 3 months' time. They were an average of about 30 odd crores. So that's just to put it in perspective, like comfortably average about 25 crores. So there, 27% were non-resident Indians. So when we were asking and we were trying to research, because before we are launching a project, sales are following, but when you do a deep dive into research, a lot of these NRIs who have made a lot of money are also coming back to the country. Their businesses are moving back. So that works in our favor because Bombay becomes their first entry point.
Yeah.
Have you seen that also?
100%. I see it all the time. We have a lot of clients who are lawyers, tech guys who worked with Google and all that, who now can work essentially from anywhere. So they're like, you know what, I want to move home now.
I think COVID changed all of that.
Absolutely.
Especially the second home concept and Goa as a destination.
100%. 100%.
So Goa has changed by then, for sure.
Goa has changed by COVID also. Like I'm telling you, every techie that I know, a startup I know now is formulated and has an office there.
Goa.
So one of our recent PropTech investments is from a startup whose base is in Goa, and I'm asking him, your company has nothing to do with real estate in Goa, and he's like, no, but it's a great base. My techies are here to work. I get great people to work, so I set my startup over here.
Such a great life, right? You know, it's that beauty where you have space, you have all of that.
And
but you
the
have
best restaurants now.
best, without a doubt, but great infrastructure. You have a new international airport in the north, you have the current airport in the south, you have highways, you have roads, you have and don't have electricity. But you solve for that. And you just have a great quality of life. It's the only place where, if you're maybe not the only place, but it's one of the few places I have seen. If you're a woman, wear your bikini, get into a car, drive alone to the beach, spend the day there, drive back at night once it's dark. Nobody, not for a second, will you feel uncomfortable. Not for 1 second. It's this invisible thing called, social infrastructure. What we define internally as it's an invisible thread that Goa has, and it's unbelievable.
And it also has great air. That's why half of Delhi has bought homes there.
100%.
Like half of them are like, okay, now it is time for us to go to the Goa house.
Exactly, but that's what I'm saying. But a lot of places in India have great air, right? It has great air,
But
air
Goa-
coupled with accessibility, coupled
And
with
the beach. Yeah.
coupled with greenery. If you don't, my father hates the beach. He loves Goa because Goa can be the mountains, the hills. Goa can be the
Everything, yeah.
water, the rivers. It's just got everything.
So just to ask you again, out of curiosity, I was just thinking, I visit Goa quite
Yeah.
regularly, and I love the place, obviously.
We'll talk offline about
Yeah,
it.
yeah. No. So maybe
One more
I,
customer.
not really. Maybe you will become my customer.
yeah, the great house, yeah.
One trend which I've seen. So growing up, though I'm working with Birlas, but
Yeah.
my family's always been into real estate. We do hotels, we do a couple of other things which is back home. So one trend which I've seen, and I agree with her, that land gives the highest amount of appreciation. I'm comfortably working here, living my lifestyle because there is some land parcel which I bought from my savings. It's still growing. And in Bombay, obviously, whenever you want to sell it, you have a 100 crore rupee house, you can sell it tomorrow morning. That only happens in Bombay. But one trend which I've seen, coming from a smaller town where I started, there are trends which defines a location. We start going there suddenly, and then that becomes valued in terms of real estate. And then after a few years, suddenly the entire trend changes, and then you have a new place. Like 15 years back, I think 12 years back, you guys started. 8 years back, you guys started.
8 years, yeah.
So Goa was very different. You again giving credit to you guys that you could really create those first few bungalows, and they were looking amazing. The right kind of people picked up, and then it became talk of town that do you have an Isprava house? Have you stayed there? I went for my friend's party and this and that. So how do you see that as a countermeasure when it comes to real estate? I really wanted to ask you. Maybe I wanted to ask you offline, but then it just came out. Because after 5-7 years, the trends will shift. You will have a new space which will maybe become the next future Goa, which we are seeing in smaller, in different states where people are liking. Like luxury homes are selling in Udaipur lately, where 30 crore rupee homes were sold very fast. Because Ahmedabad people went there, there was alcohol available, they could see water, and there was
Lakes.
yeah. And lakes
palace.
and palaces, and they were used to paying 2 lakh rupees a night in the hotel. They thought that this is an interesting thing, and they've got amazing amount of returns because whenever weddings are happening, they kind of put in on rent, these larger things are actually going for 10-12 lakh rupees a day because hotels become expensive, you get more guests, you lease out these properties. So, and you're doing something in Kurg, if I'm not wrong, right?
Kunur.
Kunur. Sorry, I'm a little confused with south of India. But yes, so how do you see that happening in real estate? Because as an investor, they look at 5-7 years, maybe the crowd will understand it and their questions on not buying or buying a second home. I love second homes. And my investment has always been into land and buying those things. And obviously, apartments are important in Bombay because that gives you rental income, which is very good. Only in Bombay, nowhere else.
Apartments are most important because homes are important and Bombay has no
Absolutely,
homes.
absolutely. And there is an upgrade, it will keep on going. But then suddenly you also have DLF, which does some 13,000 crores of large value homes, which you've never seen in a place like Gurgaon where.
But that's a different model. I will give it to them. I mean, kudos to everything that they've built and the way they've built that area. Gurgaon exists because of Camellias. It's called the Camellias Club right now. Every startup guy is there. The Camellias Club went to Davos. They went to see Elon. It's the Camellias
So
Club.
now that's called
It's part of
Dahlias.
it.
It's called Dahlias, where they did 13,000 crores. It's
Yeah,
unreal, but yeah,
they
it's happening
built
in this
They
country.
built it.
Yeah.
And I'll give it to them. And they control their price the best. You try and sell an apartment in Camellias, Ralias, Dahlias, wherever. You try and sell it less than what he wants you to sell it. He'll buy it out.
Yeah. That's what
And
Uber
then
also
he
does.
will,
Yeah.
and then he'll switch. And he'll switch it at his price. You have to give
That's
it to them.
working for them, but coming back to this, how do you think that all of them should know that it's not really going anywhere? You can still get that value, you can still get that rental. Because people do get scared of these things, and I do as a real estate person. In India, the best part is you're working in real estate, they don't care, but if they're buying in Timbuktu also, they will call you. And then you have to tell them that, uncle, I don't know about this place. Let me ask you friends and I'll come back. And sometimes if the pipe is also leaking, they will ask you that, how do you fix this pipe? And then you have to tell them that, yes, maybe I know a little bit, but not really. So, like, maybe the audience will.
So I'll let Dhimaan quickly address it because I have a hard stop coming up in a minute.
I saw you shifting uncomfortably in your chair, and I was going to say, look, we can take this offline. Do you want us to take it offline? I'm happy to.
If you want to quickly address it, you can.
Okay, if I have to address it very quickly, Goa is going nowhere. No, jokes aside, in my view, and the short answer is Goa, and let's talk about the non-yield side for a second. Let's talk about the capital appreciation side for a second. Goa is a very, very unique problem, right? National and international demand. Everyone wants to buy. Alibag, your buyers are Bombay, primarily. Kasoli and the north, your buyers are people from the north, primarily. The south, it's the same, right? Goa is the only true national and international destination India has, period. It has been, it is, and it will continue to be, even at a far greater speed, actually. Point one. Point two, supply is incredibly difficult in Goa. You have Portuguese land laws, which means half the properties are litigated and they're not clean titles. Not even half, that's 60-70%. Secondly, Goa is a state, it's a small state, so a lot of good land goes in CRZ. Thirdly, leave aside the title defects of Portuguese land laws, most of the plots that are clean, also someone's fighting with someone. And there is this very strict zoning regulations in Goa outside of CRZ, just settlement land, orchard land, private forest, which leaves very little developable land actually in Goa for someone to buy and develop. So Goa is on day one in terms of price appreciation. That's my short answer. We can obviously take it offline.
No, I really wanted the audience to know this because maybe we as a brand might do something interesting there also. But it is what it is, that land is not being manufactured. And Goa is difficult.
Perfect. Thank you so much, guys. I'm going to quickly open it up to Q&A from the audience. If anyone has a question, please raise your hand and I'll try to get a mic across to you.
This panel was largely focused around what would you do if you had 20 crores right in the bank. That's obviously not the case for a lot of people in Mumbai. So here I ask you all to, for a second, put aside your main business. And if I come to you as a young 30, 35-year-old who's really, done as much as is possible, and I've put together maybe a crore or two in savings that I'd like to divest in real estate. I still have stock market holdings that I want to keep. I'm just willing to put 1-2 crores. What would you tell me to do? From a personal perspective, not keeping in mind your business.
I'll go. um, put it into something that she's doing. If you want real estate exposure, the ticket size works. Put it into a structure with us. You know, we essentially, when I say us, I think put it with someone who will take that 1.5, 2 crores, try and come in. Then I do agree with her in a kind of early stage land. This thing, you can never do land alone. No retail person can ever do land, so forget about it. Do it with someone who's doing land, and essentially, yeah, has the expertise and get an equity IRR. Don't do a debt deal, do an equity IRR where you're willing to take a little bit of risk with the developer, with the AIF, and take out 20-25% returns, right? As an IRR, it's more than actually over a 5-7 year period. That's more than a stock market will give you, not in a bull run, right? In a steady state. So that's what I would recommend.
And I would actually try to understand what is it that this money is kept aside for. If it is to buy an apartment as a need of yours, then buy the apartment. You would get a great deal in probably, uh, you know, probably in the next 12 months you'll get great deals in a place where you can flip it. But if that's not the need, then yes, either put it in an AIF where you're sure that your money will make money, not a debt structure for sure. If only equities are going to get your money doubled. Debt will give you a steady return, which is fine. But if you want to double it and it's an opportunistic money, then definitely put it in a structure where you get either land or you get an AIF or you get an equity return on real estate.
So very similar thoughts, but it also depends on where you are currently in your thought processes. If the asset gives you some sense of security, definitely don't think too much. Just pick up an apartment somewhere. That will give you that security. If that security is not required and it's in surplus money, then it's all about returns. Then maybe multiply your returns by differential instruments and then come back to real estate and buy a bigger number. That's what I would suggest. Or maybe buy a second home also. That can be an option on cards a little later. So it all depends. If that security is required and it's important for you, don't think the first thing for all of us Indian is to have roof on your head, which should be owned by yourself. Your family can have it. That security is taken care of, then maybe diversify. Otherwise, just start with basic real estate.
Yeah, and I also want to clarify, while I said land gives you the best return, please remember there was a movie called Khosla Ka Ghosla. Please remember it before you guys as retail investors want to go and buy land. You really do not know what you're buying. Please go and put your money with someone who knows it. It is not the most easiest in India to buy land. He spoke about Portugal laws. I'll tell you archaic laws which the government doesn't want to change. But you really don't know who's the owner at the end of the day. There are no land. Forget land. There is an apartment which was sold in 1976 in Altamount Road. Today, if you go to buy it, you really have no idea what's written in that document. So please be clear, if you guys really want to get into land stage as a retail thing, put it with someone who understands it or get a right lawyer on your side who will help you with it. Don't just find, MS Kulkarni and company and say, "Hi, please go and get my land done." You will get a Khosla Ka Ghosla, which is not a real estate sector issue. It is your personal choice.
And when you go to the right lawyer, then your investable surplus comes down by a lot.
But it's safe.
And I think that's what, just to add to their points as well, I feel like that trust factor is very important in real estate. So whatever anyone does, whether it's land, whether it's apartment, whatever it is, make sure you have experts guiding you who you trust through that journey. Otherwise, there are a lot of pitfalls that you might not be able to avoid.
And interestingly, now it is a technology world. Everything is very, very clearly visible. Please make use of technology. Please go to RERA websites. Please check everything. Wherever you are investing, just double click it. You will have the right kind of answers. So you need to be very, very careful in what you're putting in, because these are larger chunk of money which goes into real estate. And on a click of a button, it doesn't come out that soon. It's not stocks. So you have to be very careful who you are putting monies with.
Any other questions? Can we have a mic to him, please?
Hi, so I have a question to compare buying a new flat versus investing in an AIF. When you buy a new flat, you obviously have access to more funds because you can get a loan against property and then build up that way. Versus an AIF, will I be able to get some kind of building that way?
If you buy an apartment which is, if you go for a loan, 25% of that corpus is anyways going to come from you. If you're buying an apartment in Bombay where 25% of the corpus is coming with you, you can easily put 1 crore in the AIF. At 1 crore, you're going to get ownership on multiple assets in the AIF versus you owning one property. You come at a stage where the approvals are there, the risk is deleveraged, the developer has upped his price. So you don't get cost price. So your return obviously is reduced. You'll end up making 6%, 7%, hedge it, interest saving, tax saving, somewhere that's it. AIF, even if you put 1 crore, you put your entire 25% IRR on it or double it in about 3.5, 4 years. It's much better as an investable amount. Because you are still playing on 25% and taking a loan. Here, you are not taking a loan, your money is doubling. You don't have a liability on you. Plus, you're saving 11% on your stamp duty and GST. So, it works better.
Anyone else?
I think so far, great sort of insight from all three of you. My specific question is related to the funding aspect, specifically in the RE sector. So, do funds or the funding ecosystem prefer, you can say, high density, safer price points to sort of fund with when it comes to projects, or more unique developments which are focused towards the higher end of the segment in today's day and age?
So I'll take that. Okay, I'll break it down for you because I've done that for the longest. A private equity fund, which is an FDI fund, is not going to look at any developer. He'll look at the top 5, top 10 developers in the country. And they also only look at Bombay, Bangalore, Chennai, Delhi. They are not looking at the rest of the country. FDI domestic fund, not an FDI, but a AI domestic fund, which is like an HDFC, ADIA, ASK, Motilal, Mountain, Next Round and all, will work with all developers in the city. For them, the return matters. A high density project will ensure that your price is compromised because you have to ensure that your stock is safe, and at the end of the day your margin will be compromised. There probably you have a debt product, you don't have an equity product. And it doesn't work for the developer. I will never recommend a developer to go to a fund for a high density project. You try and come up with your corpus, go to a bank, get a nice loan and get a 10-12% money on it. Not a fund kind of a structure where it doesn't work for you. Largely, I think today most people have got smart. Lots of cycles, whether it's Dhimaan, ILFS, RERA, have changed the way banks, financial institutions look at RE as a sector. They've got a little smarter, their underwriting is better, and they're all looking at the bottom line. So what is the bottom line? As a security coverage, depending on debt and equity, it works. It's not about, and it's about the person. And it's about where the project is. Does it have its approval? Was a track record of the developer and so on and so forth. So I don't think high density is a challenge. In that situation, Park would have not got funding. It works.
They also funded a lot with QIBs, etc., being a listed organization.
No.
So
So that's a very long chapter.
Yeah, that's a long
Maybe you need to spend more time.
That's a lot.
Yeah, so thank you guys. Thank you all for your insightful answers.
Thank you.
And thank you for being a very
Thanks for
patient
having
audience. And yeah, on to the networking session.
Yeah.
And thank you for comparing very well.
Thank you.